What I'm going to be introducing you to today is MCAs and ACHs, Merchant Cash Advances and Automated Clearinghouse Advances. ACH. ACH is an Automated Clearinghouse Advance. Unlike a Merchant Cash Advance, we do not need a credit card machine present at the business itself. What this is this is set up for business owners that work off of cash or checks or wire transfers. In order to qualify for an advance through an ACH program, you have to have a $20,000 minimum sales per month. In order to qualify for an ACH loan or advance, not very good at spelling. Anyway, in order to qualify for one of these loans, what we need out of you is 6 months bank statements and a small application. Credit does not come into play for the business owner other than for grading purposes, and that's it. And we're going to grade the file A through D, just like the mortgage industry. So A being conforming, D being non-conforming, and in between. In addition, not only will they get less money if they have poor credit, but what will also happen to them is they will get a higher rate. What we call in this industry a factoring rate, or an abbreviation of FR. Okay? So that said, again, a D-rated client on a scale of A through D would get just less money, and in addition would be in a situation where they would have a higher factoring rate. Now I want to talk about factoring rate for a moment. Factoring rate has to do with the cost of the money, not an interest rate. There is no interest rate here. Nothing accrues during this period that this loan is out there for the business. So in the event that somebody borrows, let's say, $50,000 from us and has a factoring rate of, let's say, 20%, okay, that would be 20% of 50 grand, which is $10,000. So what the consumer would be paying back on this product would be a gross total of $60,000. So factoring rate again is the cost of the money. All right? That's the factoring rate. In addition, we have, I guess my FR is not real good there. I'll put another FR in there. The factoring rate, cost of the money to the consumer of the product. In addition, what we have here is we have what we would consider the amount of money that we would take from the consumer of this product, or business owner for that matter, each day off of or out of their credit card processing machine. What we're going to do is we're going to attach a UCC filing to the credit card machine, and that's called a lien. And that lien can range anywhere from 10 to say 40% of their daily receipts. So with an ACH product, it operates very similar to an MCA, but all we have in regards to how we take the money off is, or out of the account is, out of their gross sales, we're going to take a set dollar amount, not a set percentage of their gross sales. So as an example, let's use a business that's doing $30,000 monthly for our formula here. This business is going to have, let's say, a factor rate of 20%, and that's the cost of money. So 20% of 30,000 is $6,000. So they would owe us $36,000 once we lent them the $30,000. And how we would recover that would be a set daily amount. Let's use a number, dollar-wise, a set dollar amount daily of $200. Now, in the event that there weren't any sales that day, and what we're going to take out of their account is we're not going to take $1. But let's say that day they did $100 in gross sales. We obviously can't take the set amount we've agreed to in a contract of $200. So what we're going to do is we have a number that's predetermined in here in the contract of 10%, and we're going to take 10% minimum that day of the daily sales, since it didn't hit the daily minimum of $200, so we could take $200 from the bank or from the business owner. We're going to take 10% of the $100. So we're only going to take $10 that day rather than the agreed upon $200. In the event that the business owner has a huge sales day with this company, and he does, let's say for number's sake, he does $100,000 that day, we're still only going to take the agreed upon worst case scenario of $200. We're not going to take 10% of the 100 grand. So what you're going to have is you're going to have, for number's sakes, $30,000 on your contract that you're going to get from us put into your bank account. And you're going to have, as I mentioned earlier, a 20% factor rate on the money. So your payback is $36,000. And we're going to have a set daily amount that we're going to take out. Again, the number is $200 for this example. Okay? And that $200 works against the $36,000. So each day $200 is deducted from $36,000 owing. So you can do the math on that and see how many days that takes you to pay back. These are short-term loans. They're not amortized out over 25 years. They're typically amortized out over 4 to 6 months. How do we come up with what you qualify for as a business? Typically, you can qualify for 1 to 2 times your gross monthly sales. But in the event that you have poor history of paying your loans back, or maybe you've had a blemish in your lifetime, like a BK, even if it was a medical BK of some sort, or a personal BK, or a business BK, it still goes against your personal credit. So credit does come into play here. Okay, but unlike the banks, we're still going to give you an advance. It just could be that you qualify for less. Maybe you don't qualify for $30,000 as a D borrower, because these loans are graded A through D. So maybe as a D borrower in this case, even though your company, as I mentioned, we can go 1 to 2 times your gross revenue. As a company, let's say this company is doing $30,000 a month. We may only give them $15,000, being as though they're graded as a D product. So we've got advances that range anywhere from A through D. And again, the only reason credit comes into play is in the event that the credit is poor, we're just going to give you an offer of less money.